as a tutor, and in today's tutorial, it happens to be the continuation of the course BFM 303. Do also smash the like button, use the comment section to say hi, hello, tell us where you're streaming from. And for those of you who are not yet a member of our private class, do also visit our official website www.com, where you get to become a member and you have unlimited access to our repository, where you will be getting all resources that will enable you to cement best grades this semester. With this being said, let's jump straight into it. Okay, we have BFN 2303. BFN 303. I believe you all can hear me. Are we all together? BFN 303. Awesome, awesome. The audio is checked. Audio is checked. Okay. Now, we are taking, in today's class, we'll be taking position statement. Position statement. We'll be getting to find out what it means by position statement, okay, and why it's so important. And 303 position statements. When we talk about position statement, what are we talking about? Okay. Now, I think there's a mix-up somewhere. The live class now is ENT202, so we can't actually end the class. So we are just going to do ENT202 now, and we are going to return back to BFN 303. So just let's quickly make the adjustment. Let's see, due to some time. The the thing, okay. Can we hear me? Okay. Just a moment. I think I need to fix the audio. Yeah, I think the audio is now the PCB, meaning the private corporate business. The private corporate business, we are talking about corporation owned by members of the public. Okay, corporation owned by corporation owned by the member of the public. All right, owned by members of the public. Owned by members of the public. Therefore, such corporations are limited by shares. Okay, the public corporation businesses are limited by shares. Okay, they are limited by shares. Now, this private corporation business are also known as joint stock companies. All right, they are also known as joint stock companies. Okay, they are also known as joint stock companies. So what we also need to know is that this PCB is subdivided into two, as we have the private and we have the public. Now, the private company says that a shareholder is not permitted to transfer his share, all right, without the consent of the company. Okay, but when we talk about the public companies now, these are companies that, all right, that enabled investment of public share, all right, for the profit of the business, meaning that the public companies can sell their shares, okay, to the public for the purpose of what? Profits, of which the private organization or the private are limited or are not permitted to do. Okay, so we have that as that. It says that while the public company can invite and issue shares to the general public, the private company cannot. Okay, so we have that as that. We also have some advantages here and some disadvantages. Okay, some of the advantages of private corporations are the capital base of this form of business is very large. All right, the liabilities of the members are limited to their investments. That's the advantage of private corporation. And we have some of the disadvantages are private corporations are very difficult to form. Okay, because of the need to file documents with appropriate government authorities. Okay, there's also problem of double taxation, whereby the owners of the organization needs to pay their tax and their business as well need to pay their tax. So we have the public corporate business. All right, this is the private. So we have the public corporate business. Under the public corporate business, We are talking about entities that is created by the state to carry out public missions and services. All right. To carry out public missions and services. To carry out public missions and services. And some of the characteristics of public corporations are: it's a corporation, it's a corporate body created by a special act, okay, in the state or central legislature. The power and duties of this corporation are defined by this act promulgated by the state or the legislature of that state. It enjoys the status of legal entity. All right. It's unlike the private organization that the owner of this organization needs to go through a lot of stress in trying to observe the legal requirements as they create this business. But the states that created the law, running this business or creating this business, they have this. It's just like the owner of a thing creating a sub part of it. So they enjoy what we call the status of legal entity. Okay, they enjoy the status of legal entity as such it can enter into contracts in its own name, since it's created by the states and it's the state that makes the law. So we have the entire capital is financed by the government. All right. So some of the advantages are: a public corporation is able to manage its affairs, okay, with independence, initiative, because it is an autonomous setup. All right. Public corporations are autonomous, they are independent, independently set up. It maintains continuous existence in spite of change of the government. Is owned by the states, okay, not by the government. Government goes and come, but the state is permanent. It's one of the characteristics of the states. So disadvantages here are: they can be difficult to manage and control. Speaking of the public corporate businesses, they can be difficult, all right, to manage and control. All right, the problem of inefficiency and anything that has to do with government sometimes can be very, very inefficient. So we have that as that. Now, we want to talk about the formations of company. Formation of companies. Okay. Now, when we say formation of company, we are simply talking about the full procedure. All right. The full procedure for forming, registration, and filling of specific documents and returns of the company, whether private or public company in Nigeria. All right, they have a body. There's a body that governs the formation of this company, and the body is known as the companies. All right, there's a decree that guides, that specify how they should be formed, and that decree is known as Companies Decree number 51 of 1968. Okay, so some of the documents, some of the things you need to understand when it comes to formation of a company is that of Memorandum of Association, MOA, Memorandum of Association. Here, Memorandum MOA regulates the power of the company and fixes its object, okay, fixes its objectives in relation to the outside world. All right, regulates the power, excuse me, of the company. All right, how it relates, relationship with the outside world. Okay, The outside world get to understand what this company is all about and how we should relate to them based on this. Okay. We also have Article of Association, AOA. AOA. Article of Association are sent to registrar of companies at the same time with the MOA, right? They deal with the integral organization and functioning of the company. Just as MOA deals with outside relationship, AOA deals with what? Internal, okay? Internal organization functioning, okay? Internal organization functioning. So we have that as that. There's something called prospectus. Okay, it is an offer of share to the public. When we say prospectus, talking about the offer of share to the public and must also be sent to the registrar of the company. Okay, so we also have what we call incorporation. Having received all necessary documents and found them to be in order, the registrar of companies will issue a certificate of incorporation, meaning you are okay and you are good to start this business or company. Okay, that also the share subscription. Share subscription is when the general public is invited to buy shares. Okay, so we have that as that. Now, there's something called company amalgamation. Amalgamation refers to the merging of companies to form, all right, an organized amalgamation. All right, we have merged to form a whole. Okay, merging of companies to form a whole. Now, there are two types of company amalgamation. There are vertical and horizontal amalgamation. The horizontal and we have the vertical and horizontal integration. These are the two types of company amalgamation. So the horizontal integration occurs when firms in the same stage of productive process come together as one. For example, two furniture manufacturers come together, companies in the same line of production. All right. So we have the horizontal integration. All right. Firm in the same productive process. Furniture. Then we have the vertical integration occurs when firms at different stage of production process merge together. Timber dealers merge his business with furniture manufacturer. The same industry but different niche. All right. So that is the vertical integration. All right. All right. Production process. Timber matched with furniture. Okay. So we have that as that. So we are going to call it a wrap here. And in our next class, we are going to take it from organization and management with few more classes by volume 6. We should be calling it up with this course. Thank you very much, everyone. I believe you've been able to gain something in today's class. Please let's keep our notes up to date and send them to the appropriate quarters. Do have a wonderful afternoon. Bye for now.